We are not providing investment advice. Viewers take their own risk making their investment decision. We're going to talk about this company named Goodfood Market Corp. This company is, they said they are leading online grocery company in Canada, delivering fresh meal solution and groceries that make it easy for members to enjoy delicious meals at home every day. Goodfood's mission is to take the impossible come true, from farm to kitchen, by enabling the members to complete their weekly meal plan and grocery shopping in minutes. Okay, so sounds like it's a quite ambitious company. Uh, so this is at the beginning as it is a meal kit company. There is other meal kit company exist now. There is one Blue Apron in States, and there is another one. I think is oldest one probably, the Hello Fresh. So these are the competitor. So according to their description, they said they deliver fresh meal solution and grocery. So I believe the grocery was a newly added item. Um, I was I was thinking like for the grocery delivery, the in Canada like the Loblaw and the other grocery company, they are already doing the delivery themselves. So there must be ferocious competition over there, and I don't see Goodfood has the competitive advantage over there to compete with those grocery chains. Um, so that's a problem for them now. We can see the share price is going down quite a lot from peak over $10. Now it's below $1, so it's quite a drop. So we can take a look how this company is running. So let's see this company. Now the price is 60 cents, and the total market cap is 45 million. So with 75 million shares outstanding, um, they have some debt outstanding. So this data is not the latest one. So it's the third quarter of 2022. So we see over here the build up of book value is minus 78 million, almost $79 million. So we can take a look over here. So they started from, or maybe it's the data goes back to 2015. They have the deficit of $452,000, and the deficit keep growing, and it is 78 million by the end of last year. This year we see till the May 31st, it grows to 142 million already. So it's losing money like crazy. Okay, and we see the shareholder equity is also shrinking. So over here you see there is a 117 million equity. That is not because they are making money. That is because they raise money from the market when the share price is good. Okay, so let's go back, and we see the ROE and ROC, return on equity, and return on capital, both negative. That is understandable as they are not making money, so they are minus. And we see the growth rate is quite good looks. So they are doubling every year. We can check from their revenue. So here is the revenue. So from 2017, they have this revenue 19 million, and end of last year it was 379 million. So that's compound annual growth of 109%. So that looks good, but there is a big but over here. You see the share dilute rate. It is 1.5, which means the annual share dilute rate is 155%. What does that mean? That means the share is diluting faster than your revenue growth rate. So don't be excited. Let's take a look how they diluted over here. So over here, the initial share count is 100,000, and then now is 70 million. So I believe this share number is not that accurate. Okay, so it probably is because they did a reverse takeover. So it's probably the initial share account from the older company, and this probably is more close to the real number. But I would say we can take it from here. So 30 million from 2017, and to until now. So if we put it in this way, the share dilute rate is not that horrible. Probably, let's see, that's doubled in 1, 2, 3, 4 years. So probably it's 15 to 20%. So 20% annually is still quite okay. So that's the dilution. So it's not a 1.5 for sure. So this estimation is not accurate if we considering these diluting rate, and also considering the company is not making money. So I don't think this is accurate. Let's see the sales, general, and administration cost. So the company is doing well in terms of expanding their business. So the business grows quite fast. Like a annual compound growth rate is over 100%, right? But you see, this number looks quite high. What is this number? So this is the selling, general, and administration cost. This cost, you see, it is not like it's not getting better. So this cost, the compared to the revenue. So this is the ratio for the general administration cost to revenue ratio. So as we can see, this ratio is not changing too much, even they increase their revenue. So which means the size of the company didn't help them to save the cost of sales and administration. It can be either they pay them too much, or they didn't doing well in cost saving. So that's something not look good, at least to me. So over here we can see the debt. So how much the debt grow. So you see it's from 2019. This data can go even further to 2018. So 2018, May, 2 million, then 2 million, 2 million, 7 million, 10 million, 14 million, then goes up 38 million, then goes down a little bit. I believe they're doing some financing, equity financing, goes down a little bit. Then here goes up, and it goes up to 80 million today. And you see the company now, the whole company market capital is market capital is 45 million, and they have 18 million debt. So which means the debt is more than their equity, more than their market capital. It's not a good sign. And over here we can see how much they raise the capital. So 2017, I believe this is the initial IPO or the time they did the reverse takeover. Then they raise money, 10 million, 20 million, 30 million, 60 million. So this company totally have already raised, here is 140 millions over here. There's 140 millions they raised from the capital, from the market. And then now the company, now the company was 45 million. So you see it's not doing well for the investors. So okay, here we can see 2021 January 27th. They announced the departure of the CFO. Okay, so the CFO left in the January of 2021, and then 4 months later, the CTO left. So the CTO left in 4 months after the CFO leave, which is a red flag for me. And I believe that is the time when the share price is very good. As they did a broad deal public offering, 4.8 million shares at the price of $12.50. So they raised 16 millions in this deal. At the same year, in December, Executive Vice President, EVP of Operation, so Chris left in the same year. Definitely this not looking good for me. So we see these, I believe they are the founder, the partners. So they got 13%, 13%, 9%. So that's quite a good scheme. So the management have quite a good scheme over here. So here we see the compensation. So as we can see, the CEO had paid him 1.3 million in 2019 and 2020, which is the hit of the COVID-19. It's a very bad time for the market, so he reduced his pay to 770,000. Then 2021, yeah, the salary goes up higher than 2019. So it's 1.5 million. I will say this company is not making money, so this pay is quite quite high. And we see the business partner, another founder, the same salary. So these two gentlemen, the chief operating officer and the chief executive officer, took 3 million, and we see the financial officer Jonathan have the 1.69 million. So as we see, the pay is not bad for them, but it's not good for the company if the company is still losing money.
Thank you for taking the time to watch the video. You are welcome to leave a comment below to share your point of view. If you like the video, please give it a thumbs up. Subscribe to the channel where you may want to see more videos like this.